Hello and welcome back. This is David from the Personal Finance Squad. Okay, now we're going to get into Chapter 15, the basics of owning stock. And to be a stockholder, that means you're generally a more seasoned investor and you're willing to manage your money on your own or through a broker, but that means you're going to pay more. But either way, there's a high risk potential for gain and or loss. If you've seen a stock, it may have been in your 401k plan that you own that's option is a stock option for the company, but 401ks are full of mutual funds. And mutual funds are companies that own a bunch of other stocks and you're paying into the mutual fund for them to manage that stock. So it's a big difference. Now, to own individual stock, that means you actually have partial ownership in a public corporation. That's exactly what it means. It's actually a cool thing if you think about it. It is a small piece of your pie, right? And companies have thousands of shares outstanding. So there's many people who own stock, and that means when you own this stock, that means technically you are raising money for the company to run their business. So they issue these shares and you buy them. By doing so, you're hoping that you're going to make money on them, certainly not losing it. So that's your reward. And you could also perhaps get dividends, which we'll talk about later. And they take money, for example, we have written here, they could open a new factory, they could open a new building, they might need money to do R&D, research and development. There's all kinds of things. And very established companies, once they're going, they don't necessarily need the stock to run their business, but especially when you start out, like an IPO, initial public offering, like a new company like Snap just came out in 2017 in March, is that they need all this startup money so they can go public and take this money and invest it to build the business up. Let's get into the forms of stock. The first one is common stock, and it sounds just what it means. It's common. And now what that means by you actually owning stock, that means you actually have voting rights about what the company decides to do. And that mainly is to vote for the board of directors. And the board of directors are the big people, the big cats. There's not many of them, but they make a lot of money and they make the big decisions for the company. Now, you would think if you own one share of stock, you should get one vote per share owned, but that doesn't mean that's necessarily the case. It just depends on the class of stock that you have. But you definitely have rights to vote for decisions made. For the most part, those people are not going to be at the shareholder meetings that happen. They typically happen on a yearly basis, but you again have the right to do so, or you can put a proxy vote in and even vote online or by mail. In essence here, we want to point out in this next piece of information we're going to talk about here is that we're talking about worst case scenarios with financials, but these are rules with common stock, and you'll see down here with preferred stock that they have to have these rules in place in order to handle the company in case something goes bad, like there's a financial problem, there's a bankruptcy, things like that. That's why they put these things in place. Just so we can look and go a little deeper on this so you understand at least what these rules mean, is that when you're a common shareholder, if the bankruptcy occurs, that means the common shareholders, right, they will receive whatever assets are left after all creditors, bondholders, and preferred shareholders have been paid first. Again, for the most part, most companies don't go bankrupt, and most stock that you own are with companies that are robust enough to handle and stay in business, but it doesn't mean their stock price is doing very well. It just means that, again, bankruptcy isn't necessarily looming. So if you own like Coca-Cola, for example, right, they're never going to go out of business, you would assume, so you're fine. You're not going to have to worry about this. We just need to point out these rules again, as we stated a few seconds ago. Now, there's a couple kinds of stock related to common stock, and you can see participating. They receive dividend payments higher than the norm if the company returns a better expected profit. This is written in a contract somewhere. And there's convertible stock, and that means these owners can convert preferred shares into a number of specified common shares. The reason they would do this is because the dividend is fixed for a preferred holder. So, for example, if the company is giving out 33-cent dividend every quarter, for example, right? Well, that would come out to $1.22. But let's say the preferred holder is only getting 22. It means they're only getting 88 cents for that year in time. Well, if they know that the company is doing well and they're going to be able to continuously show that they can make money and get that stock price up, the dividend's probably going to go up. So they may choose to convert to common shares because they're just going to get paid more on that dividend. So that's going to conclude it for this section. And you can see in the next one here, we're going to get into stock classes, which we're going to shift down here. And we will review that one in the next video. So thank you for joining.